Hello everybody, time to take a look at Chapter 7. So in Chapter 7 we're going to take a look at inventory and cost of goods sold. By the way, inventory, that's on the balance sheet and it's an asset. And cost of goods sold, hopefully you know this already, it's an expense and it's on the income statement. Okay? So the first thing we're going to talk about are what are the different types of inventory. Okay? So, depending upon the type of business, there's different types of inventory, and it also tells you something about the kind of business that it is. Okay, so for example, let's take a look here. All right, merchandisers, people that sell merchandise. For example, Walmart. They buy finished goods and they sell finished goods. On their balance sheet, they have something called merchandise inventory, basically, or just inventory. But it's basically goods that are already done, okay? Now, manufacturers, on the other hand, so for example, Apple, they buy raw materials and they produce and sell finished goods. So they make the goods right here. This is the important part right here. They make stuff. Ford would be the same way, right? Ford Motor Company, right? So the difference is on their balance sheet, they have raw materials, being the metal and everything you make cars out of. Work in process, that's the partially built cars, at any point in time. And then they have finished goods, okay? Now, let me move this guy right here. Oops, let's move you over here. So, then they have completed goods that are waiting, completed products that are awaiting sale. And again, these are partially complete products and these materials waiting to be processed, okay? So when you're looking at a balance sheet, you can actually say, well, they only have inventory. That means they're a merchandiser. If you see raw materials, work in process, finished goods, then you know they're actually a manufacturer. So here you go, question number 1. So if you're paying attention, based on the balance sheet alone, how can you determine if a company is a manufacturing or a merchandising company? Okay? Make sure you answer the question. Write down your answer because you're going to be using it up on Canvas to do your quiz. Okay. Now, there's some decisions along with inventory management. So, for example, maintain a sufficient quantity of inventory to meet the customer's needs. You can't sell something you don't have. I'm sure you've all gone to a store and you said, oh, I want to buy this thing. And you get there and they don't have that thing, right? So, and that's not good for customers, right? They're not going to like that. Also, ensuring that the quality, why'd you do that? Making sure that the quality meets the customer's expectations and the company standards. So, for example, Five Guys versus McDonald's. Now, they both sell hamburgers, but I don't think there's anybody out there that would say Five Guys and McDonald's make the same kind of hamburger. They're both in the food business, but not really in the same ballpark as far as quality, right? And then they want to minimize the cost of acquiring and carrying the inventory, keeping merchandise on the shelf. So, when you have merchandise that's not moving, that's a problem because that merchandise costs you money and it's holding that money over there instead of being able to use it for something else, okay? So, if you're in charge, so whether you're an accountant or you're just managing the store or doing whatever it is, these things, if you're in management, you've always have to take a look at your inventory. You have to control things, payroll, stuff like that. But in this case, there was decisions to be made about inventory. Okay. So now, how do we report inventory and cost of goods sold? So remember, inventory, balance sheet, cost of goods sold, income statement. Okay. All right. So, for example, here's American Eagle, right? American Eagle, they're a clothing store. So notice here's their inventory, right? So inventory on the balance sheet, right? There's their inventory. And then when they sell it, it becomes cost of goods sold. So basically, you buy stuff, you have it in inventory, you sell it, it comes out of the inventory and it becomes cost of goods sold and it moves from your balance sheet to your income statement. By the way, when I was first year accounting student, I swear I just couldn't get some things through my head. But that's how these things are related. That's how the balance sheet, income statement, and a lot of other items are related. And if you understand that, it makes this class much easier to do. Okay? All right. So, hopefully you're paying attention. Inventory on the balance sheet becomes blank on the income statement. All right, that's question number 2 from chapter 7. Make sure you write it down in your notes. This way, when you go take your quiz, you'll have the answer right there. Okay. Now, cost of goods sold equation. So we talked a little bit more about periodic updating versus perpetual. Now, truthfully, everybody does perpetual these days, okay? But basically, the equations are simple, right? So it's like this. You have your beginning inventory plus your purchases minus your cost of goods sold equals your ending inventory. And by the way, this is perpetual. You got to remember, that's when you walk into Walmart and you're scanning. And as soon as you're scanning, it's doing the, it's recognizing the revenue, and it's taking it out of inventory, and it knows what size it is, and it knows what color it is, and all that, so that they can keep ordering stuff, right? I mean, if you think about it with Walmart, how could you possibly do this without computers? I'd like to know. Actually, can you imagine the amount of people it would take to do that? By the way, periodic updating, this is kind of old school. What you would do here, you would take your beginning inventory, say it was 100. You'd add purchases. Then you'd subtract your ending inventory, and that would give you cost of goods sold. But basically, it's old school, no computers. You'd have to go there and count it, okay? People don't do that anymore, okay? All right, so now we're going to compute costs using 4 different inventory costing methods. And yes, you need to know it. It's going to be on the test for sure, 100%. You will see this on the test, okay? All right, so here are the options. So you got to remember, a business has options here. So a lot of times people think accounting, they have rules and you have to follow those rules all the time. There are a lot of rules in accounting, but they do give you options. And you choose this based upon your business and your needs. Like how you're running your business. How do you want it to go? So here are the ones: specific identification, first in, first out, last in, first out, and then weighted average, okay? And we'll talk about each one and how they're different and how they're similar and when you might use them, okay? So, first in, first out, that stands for FIFO. Last in, first out, LIFO, okay? So here you go. Question number 3. What does FIFO mean? Hopefully, we just saw it. Hopefully you know. Write it down. It's going to be on your quiz. All right, so here's an example. So it says, consider the following information. On May 3rd, we purchased 1 unit for $70. On May 5th, we purchased 1 more unit for $75. And on May 6th, we purchased 1 more unit for $95. And on May 8th, we sold 2 units for $125 each, okay? Now, so the question is, we have these different costs, right? And so you've got to say, well, how do we want to account for those different costs? So the first one we're going to talk about, and then we're going to use that to go through a few different things, is specific identification. So notice here, let me change this over to my highlighter, okay? This method individually identifies and records the cost of goods for each item sold, okay? All right, so in this case, with cost of goods, they would tell you which ones were sold, but they would identify exactly which ones. By the way, these are normally expensive items, okay? They're normally expensive items, cars, rings. Can you imagine a jewelry store? Do you think they just have a code that says diamond ring? They know exactly which diamond ring. They know exactly how big it is, how many carats, all this kind of stuff, the cut, everything. So cars, diamonds, rings. And so here, so let's see, if the items sold were identified as the ones that cost $70 and $95, so they say this one, they're saying, what if we use that one and that one? Then cost of goods sold would be $165, and the remaining inventory item would be $75, okay? In this case, at these prices, it's probably not the case, but they're just giving you an example. So remember, specific identification, you know exactly which one it is. You're like a car. A car has a VIN number on it. They know exactly what that car is. All right, folks, that's part 1 from Chapter 7. Back with part 2 in just a minute.